Okay, so welcome to today's tutorials of I actually try to talk about market structure today because of some messages I've received. In my last video I actually did was about my pre and post market analysis, and since then I think I haven't done anything. I haven't had enough time, so I just had some few meals some time ago, and today I decided to talk about market structure, which is very important if you would want to try or be very good at price action analysis. I think you would have to understand market structure. Even if you are using the indicator for your trades, you have to understand market structure, which is very key to the development. For every trader's development, market structure is very, very important. So let's get into it. But before that, just a quick update on my previous analysis on the dollar index. Okay, now if you watched the previous videos, I was calling for a buy around this area. Let me see. I was calling for a buy around this area where I've used this rectangle to mark. You can see a rectangle over there. So I was expecting a buy around this area, but I wasn't. Initially I expected it to be around this area, but I wasn't given that until we took out this low over here. Okay, then price consolidated a little bit, then we had a break in market structure, then a pullback, and then finally we've had this price swing over here. Okay, now I wasn't actually expecting price to move in that fashion, even though I was expecting a long-term buy on the dollar index, but I think it was based on the FOMC that we had this swing, which was consistent, which was also in line with the commitment of traders reports. The commercials were accumulating the dollar according to the COT. Okay, so just on the updates, this is what has happened since I last updated or I posted a video. Okay, so let's go straight to market structure. So what is market structure? When you want to consider market structure, you would want to know where price has actually traded from. Okay, you'd have to know where price has actually traded from and where it is currently going. Okay, and also you would have to know your swing points. When you say a swing high, a swing low, what does it mean? Okay, now if you take this range, okay, this range, any high, okay, any price swing with a lower candle on its left side and then another lower candle or another high on its right side. So you have this high on taking this particular candle, for instance, you have a low here and then another low here. Now it makes this price with a swing high. Okay, now the reverse is true for a swing low. If you take a candle like this, okay, this is not. If you take a candle like this, okay, now on the left of it we have a higher low. Okay, we have a higher low. Then on the right of it we also have a higher low. So this low over here is a swing low. Okay, so I think that is key to understanding it, and then I think that is basic to the best of my knowledge. So when you want to consider market structure, first of all you would actually want to know all these swing points that we've talked about. Okay, so usually my most traded pair is the USD, and then I've actually tried to add the USD card to it, and I'm also trying to get a new strategy for my swing trades. That's why you see all these pairs opened over here. So I will actually use one of these pairs to explain or to talk about the market structure. But let's first start with the pair I mostly trade, which is the EURUSD. Let's start from the higher time frame. Okay. Now, anytime you are considering a market structure, you would want to get a swing high and a swing low. Okay, you want to get a swing high and a swing low. Now, whichever one is broken, that is where price is most likely to go. I didn't say that's where price is going to go. It is most likely going to go. So if we break this high, now price is most likely going to go higher. And if we break this low, price is most likely going to go lower, depending on where price is coming from. Okay, all right. So let's see. Okay, now this figure that I've drawn over here looks like a triangle. If you should close this side, this triangle like figure I've drawn over here is I'm using this one to depict a high, okay, and then I'm using this one to depict a low. Okay, now anytime we see price breaking a significant price point, so assuming you have a price point at this end, okay, a high here, anytime you see a high which is broken, so let me bring this one a little bit down. Now a high which is broken, okay, now we expect that after that high has been broken, price will trade down, okay, will trade down to the midpoint of this range. Okay, but then as I said, it should depend on where price is coming from. If we were coming down from a bearish standpoint, okay, and we break this significant high, now we expect that this high should be intact. If you should get a retracement, the retracement should only be about 70% or 75% of this whole range at most. When it gets to 50%, it's okay for a buy. Okay, that is called what do you call it? A balanced price. Okay, so or like let's say a fair value from this high to this low. The midpoint of it, which is around this area, is a fair value to buy more or for more accumulation. So let's say if you should take out this high over here, okay, so on the high here was taken out around this area, price moves up a little bit and get a retracement back down like that. Okay, back down like that. Now the next movement that we are getting, we should expect this high to be taken out. Okay, now that's for a bullish standpoint. As I said, it should depend on where price is coming from. So if we were bearish, okay, price was making lower lows and then lower highs, and we have a significant high which was broken up here, around this area. Okay, and we have a retracement to about 50% of that range. So if you should take your fib and then you measure from that low to that high, now 50% of it should be okay for new buying. Now I'll talk about why it's okay for new buying. And so from that side, after you've seen that price is having a reaction around this area, now our next point of expectation for price to reach is above this high. Okay, it's above this high, and if there is another high, probably here, okay, now we should expect that high to be the next one to be taken out. Alright, so this is the first high that should be taken out, this is the second high that should be taken out, in that fashion. Now anytime there is a significant break in market structure, okay, or anytime a swing high or a swing low is broken, what you should also have in mind is that you should expect price to retrace a little bit, then continue its direction of movement. Now back to the market structure that I was talking about. Now before this high was broken, okay, before this high was broken, you should know that all sell stops around this area should have already been taken out. Okay, should have already been taken out around this area, which is what we are having over here. Okay, which is what we are having over here. So assuming price just came up to this side to create somewhere here, to create equal lows over here, and then it broke the market structure up here. Now it is highly possible, the probability that price is going to come back and take out these lows over here, okay, this relative lows over here is high, okay, because this usually shouldn't exist, and if it exists, it will be a pull on price to reach out for them. Alright, so price would have to take out the lows or the relative or the equal lows over here, depending on how they are. It will take them out before continuing wherever you want to go. In this instance, we are taking the bullish market structure for example. So if you have a relative equal lows over here, price should take them out. Okay, price should take them out, then we break that high. So right now you should expect this side as your real breaking market structure, as it was around this area. Okay, so if you have something like this, okay, and then you have a breaking market structure, now over here we expect that price would retrace about 50% for price to move up a little bit. Now if we should take out this high, then come and take out these lows again, okay, which is possible, it can happen, and it happens in price. We take out these highs over here, now we expect that price should retrace only about 50% of this range, from this high to that, from this low to that high. Only 50% of it is optimal for price to move up, but price moves below this low. If price moves below this low, then we should expect the bearish stance to continue over here. We should expect the bearish stance to continue over here. Alright, so even though we made this high over here, price still came back to this side. Okay, now price came up to take out this low, which means we are still bearish. And when we have our pullback, as I said, anytime a low or a high is taken out, you should expect a pullback to about 50% of the range. When we have our pullback about 50% of the range, which is around this area. So let me see. About 50% of the range. Okay. Now here we expect that price should target these lows again. Alright. So the market structure is still intact for the bearishness. So you should actually watch out for them. So yeah, and there. All right. So that is that for the demonstration. Let me take the charts for instance. Okay. So first, I said you have to watch where price is coming from and where it is likely to go. And this is a daily. Oh, okay. Shit. I have to do this again. This is a daily chart. Okay, this is a daily chart. Now let me see where we're bullish. Okay, so price was bullish. The trend is an uptrend. All right, we're moving up, making higher highs and then higher lows. Okay, on this stretch over here, from this side to that side. Okay, it's an upward. Price was moving up. Okay, so our first market structure break, or the first point where a significant low was broken along this line, from this side, come here. Okay, we had one here. Okay, one over here, but we also came back to break the high over here. Okay, let me start from this side. Now, as I said, after taking out this lows over here, okay, or the liquidity around this low, something like this. After taking them out, this and then that, price came to take them out. Okay, and then we rallied up. And then the first swing high which was broken was this side. Somewhere there. Sorry. Somewhere there. Okay, so this is BMS. Breaking market structure, right over there. So when this thing happens, what you have to know is that price will only have to retrace about 50% of the range. Okay, so price makes a pullback. 50% of the range is here, 1.1760 thereabout, which is the midpoint of this range. So around this area we should expect price to move higher, or to come and take out this high over here, right, which is right there. You took that high over here. Okay, that's high over there, and price since then price is making higher highs. And the next, after taking this high, the next high is here, and that one too was taken around this area. Okay, so as I said, anytime a high is taken like this, anytime a high is taken, you should expect what? A retracement or a breathing range as I call it, a breathing range, a time or a range in price where the market has to breathe or pull back or gets to a fair value. Okay, and then it should continue its rally. Oh, sorry. But when we have instances like this, there are situations in the markets where you wouldn't have those pullbacks. Okay, now when an instance where there is a news release, okay, high impact news release can bring about this price swing. I'll show you something that's happening in the dollar later on, maybe later part of this of the lesson. When you have something like this, or let me just open it straight up. Let me see. Yes, something like this. We had these lows, that low taken out over here. Price rallied up. Okay, and then we had the first market structure break here. This high was broken over there. All right. Then you had a pullback to about 50% of the range over here. 50% is here, so around this area. Now, if price had taken out this low, now I would have expected that it would go much lower. Okay, it would go much lower, and anytime it's rallied back into this candle, this particular candle, I would sell the dollar, right? But we had our pullback, which went more than 50%, which is much better. Okay, and then our next swing was to target this high, which is here. Okay, then you had a pullback. All right, then the next target was here. Now after a pullback, you see a swing low was formed. All right, now a swing low was formed. So as I said, anytime you see a swing low from taking out and then another swing high taken out afterwards, now what you would expect is a bullish market, as I used this side to explain. Okay, so if price broke this low, right, over here, it broke it over here on this swing. Okay, broke it and then came to take out this high, meaning we are bullish. All right, so now there can be a situation that price will take out this low, come and take out this, it will take out this low over here, right, then move up, come and take out this high, all right, then move down, come and take out this low, then move up. Now in that instance, that is a consolidating market or a sideways market or a ranging market. You get it here. So you can have that situation, but in this instance we were already expecting some bullishness on price, so we took out this low. Since we're bullish, this high is our next target. Price takes it out, then moves up on this stretch. This stretch is what I was talking about, was a news release. It was a news release that caused this stretch. I think FOMC, right? FOMC conference or so. Yeah, that caused this insight. So on the heels of a high impact news release, you wouldn't have those breaks or those pullbacks. Okay, you wouldn't have those pullbacks. So after this high is taken out, a little pullback, then move up. After this high, a little pullback and move up. After this high, a little pullback. Now you don't have those as we are seeing over here. You understand? Okay, so that is that. Let's go back. Now, so we had the market structure break, price came back, then take out these highs, all right, until a higher time frame premium reversal took place, okay, around this area. Now we are now bearish, so let's use this to analyze or talk about the other side of what we talked about over here when we were bullish. Okay, now everything said over here, the reverse is same for the bearish. First we take out lows over here, so if we are going for the bearish side over here, we have to take out the highs. Okay, you take out the highs. Now this, after price took out this high over here, we could have had a big market structure if price continued down to take out a swing low of any form over here. Okay, but we didn't get that, so we were still bullish. Price later came to take these highs, then after taking those highs, then we had a breaking market structure from this low. As we said, after taking out these lows, price took out a high, so after taking out these highs, price has to take a low for the other side of what we talked about here. So from this side, okay, let me just copy this. Oh, sorry, bring it here. So our market structure break was somewhere here. Was here. I really hate this. Okay, so that's our market structure break was here. Okay, now from here you should expect a pullback. Okay, from here you expect a pullback to about 50% of the range. But as I said, on the heels of high impact, so sorry, from here you should expect a pullback, but on the heels of high impact news, usually it wouldn't happen. Okay, on the heels of high impact, it wouldn't happen, but mostly you have that pullback. Okay, and that is a confirmation of for your price market structure break. Okay, now we didn't get that pullback and we created another low. The pullback wasn't up to 50% of the range and price took out this low, which is also something you have to expect. Okay, now let me use this to talk about something. Anytime you don't get a pullback to about 50% of the range, right, and you have a confirmation that market structure has broken to the other side, in this instance to the sell side, what you do is that since you didn't get this high reaching up to this price point now, and before you took out this low, what you're going to do is that the next swing low that's going to form, okay, which is this over here, the next swing low going to form, which is this, we expect that price would not retrace up above this high. Okay, I repeat, if you should get this instance over here where we have the breaking market structure, price had a pullback over there, but we didn't get to half of the range. Okay, that price swings range that was formed, we didn't get to half of it. Now anytime and we break this significant low, okay, this low, anytime price rallies up, anytime price rallies up, it shouldn't go above this high, because we're in a bearish market structure. That confirms the bearishness of what, of the markets that we are trading. Alright, that confirms the bearishness of the market that we are trading. Now, it is not every day, or it's not 100% that market structure is going to be the basis for your entries. Now, you should have other confirmations for using the market structure. Even though it is, if it is on its own, is very powerful, you can get almost about 70%, or sorry, about 55% win rates just using market structure. Okay, just using market structure. If you use it in combination with commitment of traders, I think it's going to help a lot. Okay, so our next swing low was here. Price had a pullback about 50% over here, then creating lower lows, and then lower highs over there. Now this thing can happen. You have instance where the market structure will break, but it was coming break the other part too, as I said in the beginning. Okay, so we were bearish over here. Okay, after taking out these sell stops, price came to take out these highs over here. Okay, these highs over here, and then we broke lower again. Price broke lower again over here. Now all these things can be expected. It's not every day that you're going to get 100% win rate. No, it doesn't happen. 99%, you won't get. Okay, everything is not 100% in markets, in trading. Everything is not 100% in trading. You use probabilities for our analysis. So that is that. Let me use a different pair for this. So let me AUD card. So the same thing happens in all markets. Okay, the same thing happens in all markets. We are coming from this side. All right. So you have to check where we are coming from. All these sell stops are taken. Okay, then we had our first BMS here on this week here over here. Okay, this high was taken out here. Price pullback, had a pullback. Then the next target was here. Okay, next target was here. We had a pullback. The next target is there. All right. Now from here, the next target is here. You could have had a pullback, but you see what you have here, some kind of the consolidation, up movement, something. So we had that swing, then we had that kind of consolidation markets around that area. Then we took out, we later took that high over there. There was not so much high price movements as compared to these swings or these candles being formed over here. Another consolidation over here, then expansion. So this one has been confirmed as bullish over there. Okay, so this side here, we have our bearish side of this trend. Okay, so we had a high taken out over here, then it came back to take out a low over the low over here, right there. We took that low right there. Then price has to take on trade to about 50% of the range. 50% is here. It went much higher, and then we traded down. Then we came up. All right, it came up. Now this side, if let's say you took a trade based off on the market structure here, okay, you were selling at equilibrium, you would have had a loss right here. So as I said, it's not every day you're going to get all your trades winning. If it should take 100 trades, I guarantee you're going to have a loss in it. Maybe 20 of them, 10 of them. You should get ready for them. All right. Okay, so that is that for the market structure. You should have to just observe where price is trading from and where it's likely to go. Okay, so and also you have to know the current trading range, like this high, this low, this high, this low, this high, this low. Okay, all those are part of the market structure you have to know. And market is all about finding liquidity and then balancing. All right, finding liquidity and balancing, finding liquidity and balancing. Now, one thing that you have to also know is that anytime price trades to, let's see, from this high to this low, 50% is it. Anytime price trade higher above the 50% mark, okay, above the 50% mark, and we are trading lower, okay, so here if price had reversed or traded lower from this side, we should expect that it will trade with much speed, okay, or high range candles as compared to if it had traded lower from this equilibrium points. I hope you understand. If we should trade from this side, the candles that will form will be smaller compared to the candles that will be formed from this side. It happens in market. It's an observation I've made. Okay, so it's the same thing. If you should come much higher and higher and we don't take out a high, if you should take out a high and then we are dropping lower as a confirmation for market structure break, that one too can happen. Okay, so that is that. So I would find time to resume the pre and post market analysis. I'm also trying to publish a strategy that is for swing trading, and it is very powerful. So let's see, along the year, within this year, I'll try and bring it out. I'm thinking about it.